There's a company in San Francisco that just destroyed $1 trillion in stock market value. You can't buy their stock. You can't short their stock. They're not even publicly traded. And that's exactly what makes them dangerous. This is the story of how Anthropic broke Wall Street without Wall Street being able to fight back. In this video, I'm going to break down 3 things. First, what Anthropic actually released and why it triggered the largest software sell-off in nearly 2 decades. Second, why this crash is structurally different from the DeepSeek panic, and why that matters for every tech investor and worker watching this. And third, the deeper pattern that nobody is talking about. 3 AI shocks in 3 years, each one targeting a different layer of the economy. If you understand that pattern, you'll see what's coming next before the market does. On January 31st, Anthropic released something called Claude Cowork, an AI agent that lives on your desktop and does the kind of work that companies currently pay enterprise software thousands of dollars a month to do. Contract review, financial analysis, sales workflows, marketing ops, customer support triage. Anthropic packaged all of that into a set of open source plugins and priced the whole thing at $20 a month. To put that in perspective, a single seat on Thomson Reuters' legal platform can cost more per day than Claude Cowork costs per month. The plugins targeted specific industries: legal, finance, sales, marketing, customer support, biology. The legal plugin alone reportedly automated 90% of NDA work. Now here's the thing. Anthropic has launched 6 AI models since 2024. Each one was more capable than the last. As per our research, none of them moved the stock market. Not even a little. The market had priced in a world where multiple powerful AI models coexist. What it had not priced in was a foundation model company packaging those models into direct replacements for enterprise software at $20 a month. That is the distinction that matters. The market didn't panic when AI got smarter. It panicked when AI got specific. By Monday, February 3rd, selling began. By Tuesday, the rout was in full force. Thomson Reuters had its worst single day in company history. The parent company of LexisNexis had its worst trading day since 1988. Gartner dropped 21%. LegalZoom lost nearly 1/5 of its value in a single session. But here's what makes this fascinating, and this is the part I want you to really think about. On that same Tuesday, the S&P 500 nearly hit 7,000. That's close to an all-time high. The broad market was fine, but software was in freefall. This wasn't a recession. It wasn't a rate hike. It wasn't a trade war. It was a $20 subscription product from a company most people outside of tech have never heard of. The damage spread globally within 48 hours. India's Nifty IT index had its worst day since the COVID crash, erasing roughly $24 billion. Infosys, Wipro, and HCL Tech hit 52-week lows. In Japan, major tech firms fell between 7 and 11%. European software companies entered drawdowns exceeding 35% from their peaks. A Goldman Sachs basket of US software stocks sank 6% in a single day, its biggest decline since the tariff sell-off. The main software ETF saw panic selling so extreme that by every technical measure, it was more oversold than at any point since the 2011 US debt crisis. Trading volume broke records going back 25 years. That's how hard the market reacted. Now let me ask you something. Does this remind you of anything? Exactly 1 year earlier, a Chinese AI lab called DeepSeek triggered a similar market panic. NVIDIA lost $589 billion in a single day, the largest market cap loss in stock market history. That crash questioned whether the AI infrastructure build-out was worth the investment. The thesis was simple. If AI can be built cheaply, maybe you don't need all those expensive chips. That crash proved temporary. NVIDIA recovered, then surged to become the first company to hit $4 trillion, then briefly $5 trillion in market cap. The Jevons paradox held. Cheaper AI meant more AI usage, which meant more chip demand. As of today, NVIDIA sits at roughly $4.5 trillion as the world's most valuable company. So the natural question is, will the Claude crash follow the same playbook? Will software stocks bounce back the way NVIDIA did? And this is where the analysis gets uncomfortable. Because structurally, these 2 crashes are not the same. DeepSeek attacked the compute layer, the chips, the infrastructure. That spending was subsequently reaffirmed by every major cloud company. Amazon, Google, Microsoft, Meta, they all doubled down on AI capex. The Claude crash attacks the application layer, the software products themselves. There is no equivalent reaffirmation mechanism. No one is going to come out and say, we're doubling our Salesforce spend. The fear here isn't that companies will spend less on AI. It's that they'll spend less on software because AI replaces it. Wall Street is genuinely split on this, and I think both sides have a point worth understanding. But here's the data point that cuts through all narratives. Goldman Sachs, one of the most sophisticated institutions on the planet, quietly revealed a 6-month embedded partnership with Anthropic. They're building autonomous agents for trade accounting, compliance, and client onboarding. Their CIO said, and I'm paraphrasing, that they were surprised at how capable Claude was at tasks beyond just coding. So ask yourself this: if Goldman Sachs is already replacing back-office workflows with Claude agents, what exactly is the bull case for the companies that currently sell those workflows as software subscriptions? This brings me to the deeper pattern, and this is the part of the analysis that I think matters most. There have been 3 distinct AI market shocks in 3 years. Phase 1, from 2023 to 2024, was undifferentiated euphoria. Every company touching AI saw valuations inflate. Rising tide, all boats. Phase 2 was DeepSeek in January 2025. It repriced the compute layer. Can we build AI cheaply? Maybe we don't need this much infrastructure. Phase 3 is the Claude crash. It's repricing the application layer. If AI agents can do the work that software companies charge billions for, what are those companies actually worth? Notice the pattern. Each shock moves one layer up the stack: compute, then applications. The next logical target is the model layer itself. If open source models keep closing the gap with frontier systems, and they have been consistently, then the foundation model company's own pricing power erodes. Anthropic, valued at $350 billion with $14 billion in annual revenue, could itself face the same dynamic it just imposed on the software industry. That's the part nobody is discussing yet. $1 trillion in software value evaporated in 5 trading days. The S&P 500 barely moved. AI infrastructure stocks rebounded by the end of the week. What's happening is not a broad crash, it's a rotation. Capital is flowing out of software and into compute, energy, and hard assets. The question that will define tech investing for the rest of this decade is straightforward. Will enterprises replace their software stacks with AI agents, or will they bolt AI onto existing systems? Goldman Sachs is already answering that question with its checkbook. The stock market is answering it with $1 trillion in repricing. But here's what I keep coming back to. Anthropic is a private company. $350 billion valuation. $14 billion in revenue. It cannot be traded on any stock exchange. And yet it just moved more public market value in a single week than most companies create in their entire existence. That tells you something about where the real power in AI is concentrating. And it's not where most people are looking. If this pattern holds, the next shock won't come from a chip company or a software company. It'll come from whoever figures out how to commoditize the models themselves. And when that happens, the companies building those models, including Anthropic, won't be the disruptors anymore. They'll be the disrupted.